Something feels deeply wrong. Prices rise, yet everything feels smaller. This is also called shrinkflation. Governments borrow more, central banks print more, yet we are told everything is under control and everyone is pretending it's fine. But if this is really all under control, why does everything feel more expensive and less free? Maybe because it's the very thing we trust our money is quietly breaking away. I'm Chris and this is Macro and Markets, where we decode systems, markets, money and power. If you want to be part of this community, please join by subscribing below, Twitter, Substack, here on YouTube. Let's begin. Every time the global system breaks, wars, recession, pandemics and so on, policymakers reach to the same playbook: expansion of fiscal and monetary base. I have looked at 4 data points confirming that. World War I, World War II, the 1960s, the so-called guns and butter era, and the COVID crash pandemic. And the playbook in these phases never changed. Fiscal and monetary policy was very expansionary. Liquidity replaces productivity. GDP grew on paper, markets soared, but it wasn't real productivity. It was policy-driven nominal liquidity growth. Every time liquidity replaced productivity, inflation replaced stability. That's what I call broken money, and this is what exactly how broken money regimes look like. It awards short-term and it punishes long-term. We have seen the movie before all over again and again, and we are watching its sequel right now in front of our eyes again. Governments run record deficits. Central banks have been raising rates, yet are lowering rates again, but at the same time quietly expanding balance sheets. The result, everything is expensive. When your purchasing power erodes and everything is expensive, you can't stay in cash because inflation eats it. But at the same time, you can chase markets because valuations are totally stretched sky high. This is the investment dilemma we face as investors today. You face a trap. Lose quietly in fiat through fiat debasement, or risk high losses or volatility in assets. History tells us this pattern especially and exactly well. In every expansionary period I just mentioned before, volatility surged above average. Bonds failed to protect purchasing power, or maybe just paired in nominal terms. Stocks rose, but always with sharp corrections. Commodities and real assets preserve real value, but with turbulence. That's the essence of broken money. There's no safety net, there's no choice. Safety itself becomes relative. Now beneath the surface, something is boiling and brewing up again, quietly. Global liquidity is picking up. Total money supply across major economies is rising, slowly, steadily, quietly. Resumes to QE on the table. Across the US, Europe and Asia, balance sheets are expanding. Fiscal deficits remain near wartime levels. Energy transitions, defense programs, industrial subsidies, all fuel the same engine: monetary stimulus, fiscal stimulus and growth. History shows us there's a rhyme. When liquidity rises, assets follow, usually with a time lag of 6 to 10 weeks. We have seen this in stock markets and equities and commodities front run this already, signaling and pricing already quantitative easing and the policy easing in. As you know, liquidity doesn't move easily. First it flows to bonds and equities, then into real and scarce assets. It's like water finding the cracks, always searching for yield, for protection, for scarcity. And in a world where fiat buys less every year, that search inevitably leads here to Bitcoin. The most direct beneficiary of rising liquidity and collapsing trust. Institutional demand isn't speculative anymore, it's structural. Spot Bitcoin ETFs have been quietly the new demand engine. Flows are steady, rules-based and constant, not driven by hype, but by asset allocation models. Pension fund, insurance, portfolio, wealth managers, they are all in, even if indirectly. Math doesn't lie, math is real. Bitcoin Sharpe ratio, how much return you make on a risk-adjusted basis, so meaning the higher the better as a number, remains the highest among all asset classes. Also, its correlation to stocks and other asset classes is either below 0.3 or between 0.3 and 0.5. Of course, it is still a risk, all assets, but even to equities, the correlation on average is not that high. Just from that perspective, Sharpe ratio, asset correlation, and other portfolio matrices, this asset class is not going to disappear. It fits perfectly into the overall portfolio allocation of assets. And this is how Bitcoin enters mainstream finance, not through emotion, but through math. Once it's modeled in, it just stays. Bitcoin has become the digital commodity every portfolio quietly needs a little of. It's no longer about speculation, it's about adaptation. For years, regulation was the wall, the brick. Now it's the bridge. The US Genius Act and FIT 21 finally clarify digital asset rules and give the go. It recognizes Bitcoin as a strategic asset. On the other hand, in Asia, Hong Kong's Leap 2.0 and China's quiet easing show a shift from rejection to normalization. Of course, just here in Europe, as usual, with the introduction of the MiCA regulation, introduce overburden with bureaucracy and over-reporting, over-regulation, and just make life impractical. The usual story, but that's another story. So we are entering the first area where liquidity, structure, and policy all align in one direction. It's a window of opportunity, not hype, but history repeating with new instruments. And despite everything, record prices, institutional flows, this isn't mania. Retail interest is quiet. Google searches are low, fear and greed index at extreme fear. Governments, central banks, retail, all on the sideline. No fancy, no parabolic inflows. No hype, no mania. That's exactly what mid to end term cycles look like. Strength without euphoria. So in my opinion, measured against equities, gold and commodities, who already front run part of liquidity repricing, Bitcoin remains relatively undervalued. No price targets, no hype, just relative strength building beneath the surface. Expansionary policy creates wealth on paper but volatility in practice. Stocks rise and fall, boom and bust, boom and bust. It's always the same. Commodities hedge but swing violently. Bitcoin fits in perfectly into that rhythm and is at the crossroad of that intersection. A new digital high beta hedge in the broken system. But here's the truth, the real danger isn't volatility, it's erosion. Fiat erodes quietly. Every paycheck, every saving, every pension, you know it, you feel it. Do you think your retirement in 30, 20, 40 years is safe? Yes, maybe in nominal terms. Volatility it leaves gives you a chance and a shot to grow. That's the cost of stability in a broken system. The slow loss disguised as safety. So what do we do with all this information? Simple, we adapt, we use information and act proactively. We diversify across scarcity, quality and agility. Bitcoin is one form of scarcity. Commodities, cash flow equities, high quality equities, productive assets are other forms. The goal isn't prediction, it's preparation. Because when you understand liquidity, you understand the system. And when you understand the system, you are not afraid, you stop reacting, you are acting proactively. We are living through the biggest monetary experiment in our lifetimes in the history. There was never this much liquidity in the system as now. Some will fear it, that's obvious. Others will read the map and move on, navigate it correctly. My goal is to help you navigate and read that map, to move in the right direction. If you found this valuable, subscribe to Macro and Markets here on YouTube, join the free newsletter on Substack below, and follow for daily macro insights on X, Twitter, because understanding the system is the first step in mastering it.